Welcome back, Basti here, and in today's video I wanted to talk about my current investment strategy and understanding my investment process to determine whether investment is viable or profitable. It's also analysis on avoiding common mistakes to understand what silent but wealthy people do to make their money work for them. Before we get into my own 5 personal mantras that I live by when I use my own investment strategy, I wanted to go over what the typical investment process looks like. It typically starts with setting an investment objective. Usually that investment objective is to guarantee a payment at some time in the future. The second part of the investment process is usually establishing an investment policy, whether it's allocating a specific amount into a particular security, real estate, bonds, or any other type of investment. The third step in the investment process is selecting a portfolio strategy, whether it's an actively managed strategy where you are regularly trading, buying, or liquidating, a passive strategy, which is what I adopt, or something that's structured that uses a hybrid approach of both of them. The fourth step in the investment process is selecting your assets. What does your portfolio consist of? Are you more inclined to market timing and are more hands-on with the portfolio, or are you more into asset picking and holding? And the fifth step in the investment process, and perhaps the most important, is measuring and evaluating your performance. When evaluating the performance of a portfolio, the industry standard example for this is usually benchmarking against the S&P while it's risk adjusted. And with that investment process in mind, I wanted to get into my investment strategies, and I would say the 5 most important pieces of advice I've received personally on my investment journey. The first piece of advice that I received from one of my favorite teachers while in Finance 101, as simple as this piece of advice is, she talked about it in, I think it was the first class, and it really stuck with me. There's really no free lunch. As simple as that is, you won't have returns without risk, and every reward comes with said risk. If it sounds too good to be true, it probably is. And if you understand that, it'll save you a lot of money, time, and headache. The second piece of advice that I received actually from that same teacher, probably said halfway through the quarter I had with her, time in the market beats timing the market. And what the sentiment of that piece of advice is that long-term consistency, having something set up in a brokerage account that takes money from your bi-weekly paycheck and goes directly into your brokerage account is consistency. And that long-term consistency, if you have something that like that set up, outperforms trying to guess short-term swings and timing the market. Because if you break down the numbers, your cost basis, whether it's when the market's higher, when the market's low, you're still buying when it's high, but you're also buying when it's extremely low because you're consistent and your cost basis evens out, and 99.9% of the time, long-term consistency outperforms timing the market. And my third piece of advice that I learned from just reading finance books, all my professors in the investment side of my education always stress that diversification is key. And you'll hear this a bunch in the industry, but to hold at least 30 individual stocks or broad ETFs to reduce unsystematic risk. Basically, this idea of 30 is it's basically to distribute your assets across different categories to smooth out volatility. Within this diversification point, it's important to understand that the total risk of anything is a component of systematic and unsystematic risk. Systematic risk being market risk like COVID, which is pretty much uncontrollable. The other component of this equation is unsystematic risk. In other words, firm-specific risk, or it's risk that can be diversified away using examples like this rule of 30 in your portfolio. Unsystematic risk is diversified away, and it usually is firm-specific. The fourth piece of advice I have for my personal investment strategy, one of the 5 foundational mantras I live by when making an investment, is understanding the efficient market hypothesis. It sounds more complex than it really is, but it is something that a person who knows about finance truly understands this. And what this hypothesis is, it's the concept that most public information is already priced into the market, meaning consistently beating the market is extremely difficult or impossible without insider info. So the price of Boeing or Lockheed Martin is already based on all the information everywhere in the world right now. Because of how efficient stocks and the exchanges are, they correctly price companies to their true market value. And unless you're insider trading or you're part of the managers and stakeholders of that company and know something that the market doesn't, according to that semi-strong, efficient market, which basically states that all publicly available information is fixed into the price according to the semi-strong efficient market, which is what we're currently in my opinion, you can't make abnormal returns consistently on a long-term basis. The argument to this is obviously technical analysis, which a lot of finance people don't believe in. And another one is the clear example of Warren Buffett and Charlie Munger. But those arguments against the efficient market hypothesis are kind of refuted with the fact that Charlie Munger and Warren Buffett saw a good product and completely went into the company, fired all the management, put in new stakeholders. They gave them the objective of maximizing shareholder value. And with the new stakeholders management in place at that company, they were able to let the product kind of grow the company for stockholders like Warren Buffett. And because of that, he was able to create Berkshire and continue that over the long period of time, beating the market consistently. This isn't really semi-strong because he is working inside the companies themselves and the market didn't know about that type of information he was getting. Efficient market hypothesis can't make consistent abnormal returns that beat the market with currently readily available information. And finally, my fifth piece of advice in my current investment strategy is to scrutinize everything. Always do your own research. And if you live by this saying, it'll be very hard for you to lose money without you knowing it. And it says, if we're being honest, it was your decision to follow my recommendation that cost you money. And with that being said, this is not financial advice. This is just my personal strategy. Now that we've got that out of the way, I wanted to walk you through my personal investment strategy, what my allocations are. I really just started investing at 20. Over the past 4 to 5 years, I've really immersed myself in learning about finance. My passion for economics, investing, and how money actually works really came from my pitfalls and some poor financial decisions early on, and really just learning from them and growing put me into the place where I am now. And in general, from an investing perspective, the number one piece of information that you should have a good understanding of is understand what the Federal Reserve is doing, what the Open Market Committee is comprised of, what their sentiment is within the Federal Reserve, because the Fed controls the federal funds rate, which is the interest rate that banks charge each other to borrow money overnight. While this exchange of money within federal banks themselves sounds far removed from investments in your own personal portfolio, it has massive ripple effects on everything from mortgage rates to any loan ever, any bond, any entity that tries to raise money in general. The Fed and its determining of interest rates ripples down and affects the cost of borrowing. When the cost of borrowing goes up and interest rates goes up, this typically signals a slowdown in economic growth and puts downward pressure on stock prices, especially high growth stocks like tech. And on the other hand, when the Fed cuts rates or signals bullish indications, it's usually a green light for markets. Money becomes cheaper, liquidity increases, and people tend to pour money into capital markets and into more riskier assets like tech. The Fed's tone is often called the market sentiment. It's just important to understand, bringing everything back to the efficient market hypothesis and why it still matters, is that prices adjust in real time based on Fed announcements, economic data, and global events. That's the essence of the efficient market hypothesis, especially in the semi-strong form, which states that, as you know, all publicly available information is already fixed into the price. And the reality is, as a retail trader like us, there are billion-dollar institutions with access to the best data, the fastest financial modeling tools, teams of PhDs, master students, and AI models trading at speeds you can't imagine. Even they struggle to beat the market consistently. That same finance professor told me that there's a reason why all investment companies are in New York, because they are directly etherneted into the market itself on Wall Street. So you just gotta accept it's a ping diff moment, and that you just gotta let your ego out of the way so you can truly build wealth. I would buy indexes and low-cost ETFs that track the market. Even Warren Buffett said it himself. Here's the clip of it.
I think that the best thing to do is buy 90% in an S&P 500 index fund.
You just got to be steady with reinvestment and let compound interest do the work for you. And with that long introduction and general understanding of my investment strategy, here is my personal portfolio and what it's structured right now as someone in their early 20s working full-time and trying to be smart with money, not even working the highest paying job by any extent. Pretty low paying job for the area that I'm in. And I'm not going to give out numbers right now, but maybe later down the road I will with more videos and more comfortability with making them. But the first portion of my portfolio that I want to start with is about 20% of my portfolio is in a dividend focused account, mainly high dividend ETFs and indexes. These give me some passive income and help smooth out volatility a bit. It's always nice seeing the dividend income come in. And then the biggest portion of my portfolio breakdown is dedicated to market tracking ETFs, primarily those that follow the S&P 500 or the market in general, primarily those that follow small and poor 500 or the market. But within that, I also include some speculative plays like 3x leveraged ETFs. And I want to be super clear that these are super volatile and risky, but they've historically ranked among the best performing ETFs over a 5-year time frame. And again, you just gotta focus on a long-term horizon and just be bullish on the market, because the market will grow in the long term, and to really fully understand the risk that you're taking on with any investment. I would say the most controversial portion of my portfolio is a 30% allocation into crypto, mostly stored in a cold wallet. Very controversial at this point in time, and I'm going to do another video on cryptocurrency, but specifically Bitcoin, because it is vastly different from every other crypto asset or digital asset out there. I do have a bit of Ethereum in the form of Ethereum and Bitcoin tracking ETFs. I'm not really one of those all-in crypto people, but I would say I'm extremely bullish on Bitcoin specifically and stablecoins. I definitely think once financial institutions get more comfortable with it, it'll be a hedge play for them against the dollar, and then the utility of cryptocurrency in general is something I'm also bullish on. If I did my math correctly, the last 10% of my portfolio is dedicated to two things, mainly because I'm passionate on them. Is to first, I hold a few tech-focused bullish indexes. On the second hand, I hold a basket around 30 individual stocks. And then with each asset allocation within that portfolio of 30 stocks, I usually do my own equity research on the company and usually do a bit of financial modeling to determine whether it's a good investment for me and to see if it's valued correctly. And that's pretty much all my investments. I'm usually pretty cash heavy than the typical normal speculative investor. I value the option to have liquidity. Having that liquidity is, I would say, valuable to me, so I can make those investment decisions if there is a right entry point for me. Not so much an investment, but I also wanted to talk about where to put your cash, because I know this type of financial information could go under the radar for some. A lot of people don't check what their annual percentage yield is in their own savings accounts. Some banks are legally scamming people with 0.01 APY percentage returns on their accounts. Essentially, they're taking your money from you that you're giving them willingly, profiting off of it from their own investments, and then giving you such a small percentage cut that it's pretty much negligible or zero, which is absolutely absurd how this is an industry standard. So I use a few different accounts to manage my cash management. I prefer to use the Fidelity cash savings account. It gives me a 4% APY yield. It's not one of the highest at maybe 5%. I know SoFi is good. Fidelity cash management account comes with a debit card. The utility of that is I can essentially attach to my cash savings account. That gives me a good APY. And on that debit card, if I use any ATM domestically or internationally, they actually refund the fee back to you, which is a really underrated perk. And it's another reason why I use that cash management account. And then in regards to retirement and 401k, one of the easiest tools to almost guarantee yourself to become a millionaire by retirement age. The important note to know about 401ks is a lot of the times they may put your portfolio allocation into some BS default automated portfolio that is usually risk averse, and you end up losing tens of thousands of dollars in the long run just because you're in a risk-averse portfolio that is meant to be slow growth generally, especially in 401ks. And then in regards to real estate, because I live in, for lack of a better term, an expensive fucking place, I currently have moved back home with my parents because the area I live in is so expensive. In my immediate circle, I really only know one person around my age, still 3 years older than me, that actually has a place of their own, and they recently just got it. That's within the city. Other than that, they're either far away, moved out, or some other circumstance. So that's really just my example of how unaffordable some of these home prices have been, especially with how absurd they've gone up since 2021 to 2023. They've come back down from Mars, but I don't really see them coming down. They'll probably be the new normal in prices, especially for rent. And being able to save an extra $2,000 every month just from moving back home with my parents, I'm able to use that rent money I would have been giving someone else, just put back into my portfolio and get market returns on it. And hopefully in the future, with that money and those returns, be able to save up on a down payment for an apartment or contribute to my future mortgage. And for me, this is just what makes sense. And until I have an exponential or dramatic career change or promotion, which definitely is possible for me, I can definitely see that happening for myself in the relatively near future. But for now, I believe this is how I can outpace the curve with smart investing, with not having to pay that extra money towards rent. I'm able to be frugal with my budgeting, and that allows me to save over 70% of my income on a monthly basis. Really just takes discipline, being smart with money, not having a giant ego. In my opinion, if you have the opportunity, which I do have, thankfully, and I'm grateful for, paying that rent to me is just missing an opportunity to grow my investment portfolio. And it doesn't get easier having to answer that question of where are you living and having to answer, oh, I live at home. It definitely hurts every time, but you only have one set of parents, and I'm very appreciative of mine, and puts me in a position where I'm able to save as much as I can and set myself up for the future. And in the long run, I know that it'll be worth it. And that wraps up the video for today. And I hope this video gave you some insight on an example and an investment strategy that works for me. You can take what you want from it. And in the comment section, let me know your guys' own experience, how you set up your own portfolios and what's worked for you. I'm sure that'll be helpful to those reading the comments as well as myself. I am planning on making a more in-depth one in regards to budgeting, and then maybe further down the road, if this one does well, I'll go more in depth into my investment portfolio in regards to numbers and how everything breaks down. Other than that, that'll be it for me. Sub up, leave a like. It really motivates me to make these videos, and it's always free and you can change your mind. Peace.